When you're planning to trade or invest, you don't need to bet only in the upside potential of a stock or another financial asset, because in practice, things can also go wrong. For example, when a company goes bankrupt or a currency loses all its value due to economic deterioration. This means that you can bet both on the upside but also on the downside of almost anything that is traded in financial markets. When you buy something today, we say that you are opening a long position, as you believe that you will be able to sell the same asset somewhere in the future at a higher price to profit the difference. On the other hand, if you want to bet in the depreciation of a certain financial asset, you can instead open a short position, process that is also known as short selling. The idea is always the same. You want to acquire the financial asset at the lowest price possible and sell it at the highest price possible. In the long position, this is easy to understand. If you think that, for example, a stock is undervalued, meaning that it is worth more than its current market price, then you should buy it today, wait for the price to rise as more investors also become aware of this undervalued asset, and sell it in the future at your target price. And during this process, you are the owner of the stock that later on you sell in the stock exchange to other investor who wishes to acquire it. If you want to bet in the opposite direction, meaning that you believe that the asset is overvalued or that the current price is much higher than what the stock is worth, then you need to open a short position. Still considering that you want to buy the asset at the lowest price and sell it at the highest price possible, it means that you need to sell the stock today since the price is too high and acquire it in the future when it becomes lower. It is in fact a bit weird, like how can you sell something if you don't own it? In financial markets everything is possible, and you can in fact bet on the depreciation of almost any financial asset by selling it short. This process of short selling can be divided into three main steps. First, you need to find someone who currently owns a stock that you want to sell short and ask him if he is willing to lend you the stock for a while. Then you take the stock that you borrowed, take it to the market as if it was yours, and sell it at the current market price. That, according to your expectations, will be higher than the true value of the asset. After some time, whether because you want to close your position or because you must return the stock back to its original owner, you need to buy it back in the market at the price of that day. Once again, the idea here is that you will only profit if the price paid for an asset is lower than the price at which it was sold. And as you can see, if you follow these steps, you will in fact be able to profit if the price of the stock or any other financial asset decreases. For example, let's imagine that a stock is currently selling at 100 euros. But you believe that this price is too high either because the company is showing signs of weakness or any other motive. So the first thing you need to do is to see if there is the possibility to borrow this stock. In fact, some stocks might be hard to borrow, depending on the liquidity, for example, and even the broker that you are using. One possible way to jump this initial step is to don't borrow the stock at all, process known as naked short selling. But this practice has been illegal since the previous crisis in most countries due to its highly speculative nature and the capacity to manipulate markets. But going back to our example once again, if you can borrow the stock, and of course this process involves some additional costs, then you can go to the market and sell it at the current ask price of 100 euros. Now you have received this amount, but you are still compromised to return the stock back to its original owner in the future. This means that you will need to buy an equal stock at a certain date at the market price from that day. If the price is, let's say, 85 euros, then you will profit the difference, that is 15 euros, since you paid less than the amount you initially received by selling the stock. On the other hand, if the price goes higher, for example to 110 euros, you will lose 10 euros because you paid more than you received. The ability to sell short a financial asset can be good or bad, depending on the perspective about its advantages and disadvantages. To keep this video simple and short, I will talk more about this in next week. So, as always, stay tuned, leave your like if you learned something new in this video, and I will see you on the next time.